Hello and welcome to the look ahead for Friday, the 31st of May with me, Fiona Cincotta, Senior Market Analyst at Citi Index. So overnight, we'll have Tokyo inflation data, also got China PMIs. In the Eurozone, European times, we've got Eurozone inflation as well as German retail sales. And then we have Canadian GDP followed by US core PCE. So just focusing first on US core PCE, that's going to be the focus. That has very much been the focus for this week. And expectations are for core PCE to increase 0.3% month on month. And also that's in line with previous month, and will also be 2.8% increase annually, in line with previously. Now, this data comes as the market's really searching for clues over when the Federal Reserve may start to cut interest rates. So we think we've had some stronger than expected data from the US in recent weeks. We've had stronger than expected consumer confidence. We've also had stronger than expected PMIs. And then today we also had the downward revision, though, of GDP, which came down to 1.3%, down from 1.6%. But at the same time, we've got really hawkish commentary coming from Federal Reserve officials who are warning that they really want to see more evidence that inflation is cooling towards the Fed's 2% target before they think about cutting, or before they start cutting rates. So the market's really looking at this data point as for clues over when that first cut might be. The market's currently pricing in a 50% probability of rates being cut in the September meeting, and the first fully priced in rate cut of 25% is in November. So here we are looking at gold. As you can see, sort of gold has been trading in a really interesting pattern. It's just sort of been holding steady this week, up just 0.1% so far, and a real, as investors wait to see what's going to happen with that core PCE. But if you can see, we know it fell to a recent low and has attempted to rebound, but was really constrained by the falling trend line resistance and that rising trend line resistance as well. So, I mean, and we've also got the RSI and neutral. So really looking for some direction here. As far as support is concerned, that level that the gold has been testing on the downside is that 23.25 level. That's also the 50 SMA, as well as a level that's offered support earlier in the month. If we do see if we see hotter than expected core PCE and stronger than expected personal spending, which will also be in focus, then we could see a break below that 23.22 level. Levels to look at for below that will be the 2300 and then the 2277, which was that April low. I mean, on the upside, if we see signs of weaker than expected inflation, signs of personal spending slowing, personal spending is expected to come in at 0.3%. down from 0.8% previously, then we could see gold look to rebound higher. Levels on the upside, watch out for 23.64. That is that level that we can see there that capped gains just the other week. And then above there, then you'll be looking for 2400 as a level on the upside. Another chart to be looking at as far as the core PCE data is concerned is the Dow Jones. Now, as we can see, this is after reaching the 40,000 over 40,000 all-time high. That it's really been falling off quite sharply, because let's not forget that this index doesn't have really the support of that AI trade that's been keeping NASDAQ and the S&P more afloat. So therefore, what we're seeing here is that pure play of concerns over the Federal Reserve keeping rates high for longer. Now, as far as levels to be watching out for on the downside, and I mean, I think this is looking fairly bearish chart here. We've taken out that 100 SMA. We've taken out a couple of key levels, got the RSI below 50. So sellers are going to be looking to extend those losses to 37,750, which is the May low. Break below there brings 37,235 into play, which is the April low. Now, if we do get some cooler than expected inflation core PCE data, then we could see some sort of recovery. Any recovery really is going to need to take 38,500 in order to be able to extend gains towards the 39 284, which was the February high. So just thinking about other data pieces that we have coming out. I said we've got Tokyo inflation. Now, I think Tokyo inflation is it is a very good lead indicator for Japanese inflation, gives clues over the likelihood of the Bank of Japan being able to hike interest rates anytime soon. Expectations are for core CPI, core Tokyo CPI, to actually tick higher to 1.9%, up from 1.6%. So, that would be a sign that things are moving in the right direction. But again, just one data print is not enough, and it's still below that 2% target. But it may just offer the yen a little bit of support, especially if we get weaker than expected US inflation. But if we get hotter than expected US inflation, then that could really cause some problems for the US dollar, Japanese yen. That's the chart we're looking at here. Interesting, we can see that there was this really steep drop off today. Actually, the pair's trading at around a weekly low after it rebounded from just near that 158 level. Now, obviously, we did have some US dollar weakness. Well, we had US dollar strength yesterday, but we had a little bit of US dollar weakness today. But I think there are a couple of things at play here. I think that 158 level is creating a little bit of nervousness with traders, because it sort of could be around that intervention level again from Japanese authorities. So that could have been something that caused that rather striking strengthening of the yen. Now, as far as levels to be watching out for, at the moment it's testing around the 156.50 level. If we get a breakthrough there, next one I'll be watching out for is 155 on the downside. If we find that 156.50 does actually hold, then on the upside, watch out for that 158 level. But again, we might find nervousness as we get anywhere near that level. So other data we've got, as I mentioned, we do have China PMI figures out. One market to be watching there will be oil and the FTSE, as well as the Aussie dollar and the US dollar. Expectations are for modest growth in the PMIs, the official PMI, so just above that 50 level. Then we've also got Eurozone inflation. Now, Eurozone inflation is expected to tick higher to 2.5%, up from 2.4%. It comes after German inflation, not the CPI reading, but the harmonized reading came in much stronger than expected at 2.8, up from 2.4%. So there is a potential to see sticky inflation in the Eurozone. And it comes after we saw wage data the other week from the Eurozone, which was stronger than expected. And also we saw today that unemployment in the region fell to a record low. Now, this obviously means that a tight labor market, that's at 6.4%, a tight labor market is going to keep wage growth increasing. And that obviously could create problems as far as bringing inflation down is concerned for the ECB. Now, I don't think any signs of sticky inflation will really knock the ECB off track for that June hike. But I think there are some questions now over whether the ECB will be able to, June cut. There'll be some questions over whether the ECB will be able to cut as much as perhaps the market was pricing in. Market had priced in 3 rate cuts between now and the end of this year. There are other questions as well about whether they should be, back-to-back cuts. But I think, if we're getting this strong labour market data and signs of sticky inflation, then I think it's less likely that we will see back-to-back cuts. And the ECB will potentially be more cautious as far as making second and third rate cuts. As far as the euro US dollar chart is concerned, this again is really interesting. We've seen the euro actually just rebound off the 200 SMA today. So that was a level that limited losses yesterday, and it's rebounded higher off that 200 SMA today, after we had that unemployment data and after we had the downward revision for US GDP. Also, the inflation core PCE was downwardly revised across the first quarter as well, 3.6% down from 3.7%. But still, that's the key level to watch on the euro US dollar. Is going to be the 200 SMA at 107.85. Now, if we get, for example, hotter than expected Eurozone inflation and cooler than expected US inflation, Then looking on the upside, be looking towards the 109 level. That was the May high. Above 109, look for 109.80, which was the March high. If we get weaker than expected Eurozone inflation, stronger than expected US inflation, watch out for that 200 SMA, as I said, at 107.85, and below that 107.25. Listen, I hope you've enjoyed what you've been watching. If you have, then please do give this video a like. And if you would like to receive more videos like this, then please do subscribe.